If you think gold and silver already had their big run, you might be early to the wrong conclusion, and I get it. You saw gold push toward all-time highs. You saw silver spike. You thought, I missed it. Or maybe you thought, it's overheated, time to wait. But here's what most people don't understand about precious metals. The big run is rarely a single event. It's a series of waves. And in bull markets, the second and third waves are often more powerful than the first, because that's when the crowd finally arrives. So before you write off gold and silver in 2026, consider this. The real move isn't about hype. It's about a setup that almost never happens all at once. We're talking about rate expectations shifting in ways we haven't seen in years, central banks still accumulating gold at historic levels, debt pressure rising across developed economies, and investor confidence and policy getting shakier by the quarter. Each of these alone can move metals. Together, that's when you get explosive repricing. And here's the scary part for people sitting on the sidelines. Most investors will wait for confirmation. They'll wait for the headline that says gold hits new record. And by the time that headline runs, they'll be buying the top, not the opportunity. So in this video, I'm going to break down exactly what's driving gold and silver right now, the key triggers you need to watch in 2026, and the most realistic scenarios for what happens next, including why some analysts are openly discussing $6.3 gold and triple-digit silver. We'll also cover how smart investors actually position for these moves without getting wrecked by volatility. Quick note before we dive in. This video is educational content, not financial advice. I'm not telling you to buy or sell anything. Markets are risky. Do your own research. Talk to a financial advisor if you need one, and never invest money you can't afford to lose. Alright, let's get into it. Welcome back to Finance Fix, where we simplify money, markets, and investing so it actually makes sense. If you're new here, this channel is about cutting through the noise. No hype, no doom-scrolling fear porn. Just clear, evidence-based analysis of what's happening in markets and what it might mean for your money. Today's topic is gold and silver, but not in a buy now before it's too late kind of way. That's not how professionals think about assets. Instead, we're going to approach this the way institutional analysts do. We're going to understand the why behind the moves. We're going to identify the when, the triggers that historically precede major repricing. And we're going to map out realistic scenarios, not just moonshot fantasies. Because here's the thing about 2026, gold and silver aren't moving on just one catalyst. They're moving on a stack of catalysts. And when you understand that stack, you start to see why this setup is different from a typical rally. Let's start with the big question that frames everything. Why do gold and silver explode in cycles? It's actually pretty simple when you break it down. Precious metals surge when conditions line up, and capital rushes in fast. First, investors start looking for safety. Something spooks them. Inflation, recession fears, geopolitical risk, and they want assets outside the traditional financial system. Second, big institutions rotate into hedges. We're talking pension funds, sovereign wealth funds, family offices. When they decide to increase precious metals allocation even slightly, it moves markets. Third, momentum traders pile on. Once a trend is established, technical traders and algorithms amplify it. And fourth, and this is key, the media amplifies it late. By the time CNBC is running gold hits record high segments, the smart money has already positioned. That's the pattern. It's happened before. It will happen again. Now let's talk about what's different this time, and why 2026 might be the year most investors aren't ready for. Session 2. The 2026 Perfect Storm. Alright, let's dig into what I call the perfect storm setup for 2026. This is the combination of factors that creates the conditions for explosive moves in precious metals. Now I want to be clear, calling something a perfect storm doesn't mean it's guaranteed. Markets can always surprise us, but when you look at the weight of evidence, the probability distribution shifts. And right now, it's shifting in favor of metals. Let me walk you through the first two major drivers. Number 1. Central banks are still buying gold. This is probably the most underappreciated force in the gold market right now. And it's underappreciated because it doesn't make headlines the way stock earnings or Fed meetings do. But here's what's actually happening. Central banks around the world have been accumulating gold at a pace we haven't seen in decades. We're talking hundreds of tons per year. The World Gold Council reports that central bank purchases have stayed historically elevated, And their outlook for 2026 highlights two key factors driving this: geopolitics and diversification. Now, let's unpack why this matters so much. First, understand that central banks don't buy gold for a quick trade. They're not trying to flip it for a 10% gain. They're building long-term strategic reserves. That means their buying creates a steady, persistent bid under the market. It puts a floor on the prices that didn't exist a decade ago. Second, think about who's buying. It's not just small emerging market central banks. We're seeing major players: China, India, Turkey, Poland, Singapore, all adding to their gold reserves. When you have that kind of broad-based demand from official institutions, it tells you something about how the world's money managers view the global financial system. Third, and this is crucial, ask yourself why they're buying. Central banks hold reserves to protect their economies. Traditionally, that meant holding dollars, euros, treasury bonds. But something has shifted. There's now a growing concern about currency debasement from massive money printing. Sanctions risk after recent geopolitical events showed that dollar assets can be frozen, and long-term dollar dominance as global trade patterns evolve. Gold solves all three problems. It can't be printed, it can't be frozen by a foreign government, and it has no counterparty risk. So when you see central banks buying gold at record levels, they're essentially telling you, we're hedging against a future we're not sure about. If the world's central bankers are hedging, maybe you should pay attention. Number 2. Policy uncertainty is now a market variable. Here's something that often gets missed in gold analysis. Gold doesn't just respond to inflation. It doesn't just respond to interest rates. Gold responds to uncertainty itself. And right now, uncertainty isn't just about geopolitics, though there's plenty of that. It's about something more fundamental: confidence in policy direction. Think about what markets have been processing recently. Questions about central bank independence, debates about fiscal sustainability, shifting expectations around who will be making monetary policy decisions and how. Volatility in the yield curve that reflects genuine confusion about the path forward. When the market can't figure out what policymakers will do next, when there's disagreement about the rules of the game, that's when gold becomes attractive. Because gold is the asset that doesn't depend on anyone's policy decision. It doesn't depend on a central bank getting it right. It doesn't depend on a government staying solvent. It just sits there, being gold. Recent reporting has highlighted how markets have been reacting to leadership expectations around the US Federal Reserve, including shifts in yield curve positioning and volatility expectations. Some analysts have noted that this uncertainty itself is becoming a driver of precious metals demand. Gold doesn't need the world to end. It doesn't need hyperinflation. It doesn't need a financial collapse. It just needs people to say, I'm not sure what happens next. I want insurance. And right now, more people are saying that than at almost any point in the last 20 years. Threat, rates, real yields, and the opportunity cost of gold. Okay, let's talk about interest rates, because this is where a lot of people get confused about gold. You've probably heard the conventional wisdom: gold doesn't pay interest. So when rates are high, gold is less attractive. When rates are low, gold is more attractive. And that's partially true. But it's an oversimplification that causes people to miss important moves. Here's the more sophisticated way to think about it. What really matters for gold isn't the nominal interest rate you see quoted on the news. What matters is the real interest rate. That's the nominal rate minus inflation. If you're earning 5% on a treasury bond but inflation is 6%, your real return is -1%. You're actually losing purchasing power. In that environment, gold, which pays nothing but also doesn't lose purchasing power, looks pretty good. Conversely, if you're earning 5% and inflation is 2%, your real return is +3%. Now holding gold has a genuine opportunity cost. But here's where it gets interesting for 2026. We're entering a period where the real rate outlook is genuinely uncertain. Markets aren't sure whether inflation will stay sticky or fall further. Central banks will cut rates or hold them steady. Growth will stay resilient or slow down. The fiscal situation will force changes to monetary policy. When you have that kind of uncertainty about real returns, gold tends to benefit. Because the whole opportunity cost argument only works if you're confident about what those real returns will actually be. Even mainstream asset managers have commented recently on rate decisions and gold's reaction as the market reprices the path forward. Goldman Sachs, for example, has discussed how gold can perform well even in higher for longer rate environments if other factors are supportive. The key insight is this: gold's relationship with rates isn't mechanical. It's conditional on the broader environment, and the current environment has enough uncertainty that the traditional rate-gold relationship may not hold. Number 4. Silver is not just a precious metal anymore. Now let's talk about silver, because silver is a different animal entirely. Gold is primarily a monetary metal. About 90% of gold demand comes from jewelry, investment, and central banks. Industrial use is relatively small. Silver? Silver has a split personality. It's monetary and defensive like gold. People buy it as a store of value, as a hedge. But it's also deeply industrial, and that industrial component is growing. Here's what's driving silver demand. Solar panels. This is huge. Every solar panel needs silver for its conductive properties. As the world pushes toward renewable energy, solar installations are growing exponentially, and each gigawatt of solar capacity requires a meaningful amount of silver. Electronics. Silver is the most conductive metal. It's in every smartphone, every computer, every EV. As technology proliferates, silver demand follows. Electric vehicles. Beyond the electronics, EVs use more silver than traditional cars. Battery connections, charging systems, internal wiring. It all uses silver. Medical applications. Silver has antimicrobial properties. It's used in wound dressings, medical devices, and hospital equipment. Now here's where it gets interesting from a market perspective. The Silver Institute's work with metals focus has emphasized tracking supply, demand, mine output, and above-ground stocks. And what they found is concerning. For anyone expecting abundant supply, structural deficits have been a theme in recent years. What does that mean? It means demand has been exceeding mine supply. The gap has been filled by recycling and inventory drawdowns. But you can't draw down inventories forever. Unlike gold, which accumulates over time, almost all gold ever mined still exists. Silver gets consumed in industrial processes. It gets used up. And when it gets used up, it's often not economical to recycle. So you have a situation where investment demand is supported by the same factors driving gold. Industrial demand is growing due to structural trends, and supply isn't keeping pace. In a year where financial uncertainty rises and industrial demand stays firm, silver can move violently. We are talking 5%, 8%, 10% moves in single sessions during momentum phases. That's the setup. Now let's talk about what most investors aren't ready for. Session 4. What most investors are ready for. Here's where people get trapped. And I've seen this pattern so many times it's almost predictable. Most retail investors look at gold and silver like this. It already ran. Gold went from $1,800 to over $2,400. Silver spiked. The move is over. I missed it. Or they say it's too late now. It's overextended. I'll wait for a pullback. Or the classic, I'll wait for confirmation that it's really going higher. And all three of these statements sound rational. They sound prudent. But they reflect a fundamental misunderstanding of how metals bull phases actually work. Here's what actually happens. Phase 1. Metals surge on some initial catalyst. Maybe inflation fears, maybe a banking scare, maybe geopolitical tension. This is the move that people miss. Phase 2. Metals pull back. Not to where they started, but enough to shake people out. The headlines shift to gold pulls back from highs. People who wanted to buy feel vindicated in waiting. People who bought feel nervous. Phase 3. The underlying drivers don't disappear. Central banks are still buying. Debt is still rising. Uncertainty is still elevated. And so metals run again, often harder than before, because now the broader crowd is starting to notice. Phase 4. This is when the move goes parabolic. This is when mainstream media coverage explodes. This is when everyone's talking about gold at cocktail parties. And this is when the smart money starts to distribute to retail buyers. The people who said, I'll wait for confirmation, end up getting confirmation in phase 3 or 4, right when risk is highest. And we're seeing this pattern set up again. Analysts have been raising forecasts for 2026, with some expecting new highs and significant volatility across precious metals. Bank of America, Goldman Sachs, UBS, these aren't gold bugs. These are mainstream institutions adjusting their models. So what does it mean that most investors aren't ready? It's not that they don't have the money. It's not that they don't have access to gold ETFs or silver coins. It's not even that they don't know about precious metals. The problem is psychological. 3 specific biases work against people. Bias number 1, recency bias. Whatever happened recently feels like what will continue. Gold already went up a lot, so it probably won't go up more. But trends in commodities often last longer than people expect. Bias number 2, anchoring. People anchor to old prices. I remember when gold was $1,200. I'm not paying $2,400. But the old price might never come back if the fundamental picture has shifted. Bias number 3, confirmation seeking. People wait for the market to prove them right before acting. By the time it proves them right, the opportunity cost has been paid. The result? Most investors underestimate how long trends can last, and they underestimate how fast metals can move when the crowd finally arrives. Think about silver in particular. Silver is a much smaller market than gold. When capital rushes in, the price impact is amplified. We've seen silver move 15 to 20% in a matter of weeks during momentum phases. That kind of move shakes people out on the downside and forces people in on the upside. Let me be clear about something. The real trigger for explosive moves isn't one headline. It's not one Fed meeting. It's not one geopolitical event. The real trigger is capital allocation change. It's when large pools of money, pension funds, sovereign wealth funds, endowments, insurance companies decide we want more hedges in our portfolio. We want less currency risk. We want exposure to hard assets. We want diversification away from financial assets. When that decision gets made, it doesn't reverse in a week. These are slow-moving, long-term allocation shifts. And because these pools are so large, even a small percentage shift moves markets. Right now, institutional allocation to gold and silver remains historically low for many portfolios. If that allocation normalizes even partially, the door gets very small very fast. And that's what most investors aren't ready for.